Trouble with financing on the horizon and underway? Just hear that mighty sound. Here I come to save the day. That means that lower interest rates are on their way. What am I talking about? Rate Spy. And I kind of... There it is, Rate Spy. So, sub 1% mortgage rates come to Canada courtesy of Hong Kong, Shanghai Bank of Commerce, HSBC. So there it is, guys. There it is, and 0.99 points, so it's less than a percentage point. Never in history has Canada Bank advertised a mortgage rate with 0 to the left of the decimal point. Fortunately, there's a first for everything. It's going, and it's going to go negative. Give it some time, and then once they go with digital currencies and you can't pull your money out of the bank to avoid runoffs in the banking system, you're just going to go digital. Where are you going to move your money? What are you going to do? You can't move it offshore. Where are you going to put it? And that's the plan. Effectively, December 4th, 2020, HSBC Canada, who's made a name undercutting its big bank competition, is launching the newest rate in Canadian history at 0.99 points. This is a milestone rate akin to landmark rates like BMO's 2.99% fixed in 2012 and the Meridian Credit Union's 1.49% fixed in 2015. In that case, it's a variable rate for high ratio insured. So there it is. High ratio insured mortgages. A high ratio insured mortgage is one with a loan to value of 80% or more, which is to say that with a down payment of less than 20 points, most high ratio mortgages are required by law to have a mortgage default insurance, which is provided by either CMHC. So it keeps going into that. Purchases only. So basically, the catch to it is you got to actually put some money down to purchase this home. So what they tried in London and Australia and a couple of other places where they tried a few years back, 100% loan to value or 100% loan to value lending. I guess you can't do that anymore, right? And get the good rate. So you got to kind of play around with it a bit. But that's for people that have been waiting on the sidelines, waiting to get into the market and say, wait, rates are really good now. You will see housing now start to make an uptick trend in Canada. This is what they're hoping for. And especially with the first-time home buyers loans, which is different in the United States. First-time home buyer grants in the States, if you own the house for 4 or 5 years, you get to keep the grant. You don't have to pay it back. But in Canada, you have to pay it back at a nice, beautiful, low interest rate of 4 or 5%. So, yeah. So there it is. In that case, a variable rate, a high rate insured purchases only with a discount equivalent to prime of 1.46 points. That discount is an all-time low as well, eclipsing the 145 basis point discount offered by a handful of online brokers in November 2019. But that's not all. The bank is launching 3 more record low rates, 1.39% on a 5-year fixed for high ratio purchases. So basically, if you high ratio, like if you don't have much to put down, they'll probably give you a fixed at 1.39 points. And 1.59% on a 5-year fixed uninsured purchase and switches, and switches, okay? So basically, if you join with them, if you switch and join with them, they'll probably work something like that out. And 1.64% on a 5-year fixed refinances a record low. So there it is. It's also got the new uninsured variable rates offers at 1.295 on a 5-year variable. Be careful with these. These are dangerous. And 1.34 points on a 5-year variable for refinances. Be very careful with these variable rates. Don't say I didn't warn you. So these are all ongoing rates, not limited time offers with defined expiration dates, and there are no strings attached relative to HSBC's regular products. On low ratio, so, okay, let's look at low ratio mortgages, also known as conventional mortgages, is one that does not exceed 80 points of the property's appraised value. So that basically, you put the 20% down, you have the equity, you are pretty much in the green space. So what they're doing is the bank, this is what they did in the back room before they launched this huge advertising, this campaign, before they launched this. What they did is they got their planners, forecasters, just people, analysts and stuff, getting together and putting the numbers together. They're kind of throwing this out there that homes So this is kind of a prediction from the bank that homes could drop 20 points in value. But if you lock in at 1% or a low rate and you do put 20% down, the bank kind of covers its over leveraging of lending, and it kind of covers itself a bit. But that's provided that if housing does go down, it doesn't go down below 20 points though, right? So what's going to happen? They're going to probably, if houses are half paid off, if you're 50% paid off, the bank, what they could do is do a consolidation, pay off your credit cards, your cars, provided it doesn't exceed 80% of the home value. So people will jump on that too, saying, wait, this is an opportunity to pay off all my credit cards, all my credit lines, and actually do something right for the first time and consolidate and pay one interest rate instead of a blended rate. This could work. So I guess a lot of analysts for HSBC were looking at this in the back room saying, look, we could do this provided we have this and we have this. So it's basically like an underwriter basically looking at a deal and saying, hey, make sure they provide us with this, and the loan or the deal is approved, right? So should you jump on 8.99%? Should you? A rate below 1% is as close to free money as Canadian mortgages have ever been. If you are a risk-tolerant, financially stable, and need an insured mortgage, you owe it to yourself to at least consider it, given our central bank is pleading to keep rates low until 2023. Consider that 20 months ago, most Canadians were paying rates 3 times higher at 2.99%, plus rates back then costing people over $9,000 more in interest over a 5-year period of a $100,000 mortgage. Wow. My parents were paying $9,000 a year in interest at 16% on a $60,000 purchased home when they came to Canada. So they're paying 16% interest back in the day, or 14%. I don't even remember what it was. And they were paying like $9,000 to $10,000 a year in VIG for a $60,000 home. So people, the free money is basically just creating these bubbles, and the bubbles will keep inflating. When the money gets cheaper, the bubbles get bigger, right? And they're creating these artificial shortages in all these major cities, and people are completely bought out of their own damn cities they were born and raised in. So compared to today's lowest national available 5-year fixed 1.39 at 0.99 rate will likely put you way ahead of the game for at least 1 to 2 years. The question is, what do you need to do? What do you do when rates march higher? That's the problem there. When rates start to go up, right? Can you afford that $1 million, right? So if $1 million is going to cost you at 1% $10,000 a year to finance, right? $10,000-$12,000 a year at 1%, $1 million. If it goes to 2, you're paying 20 large a year in VIG, right? And then if it goes to 3%, you're paying 37 large VIG. Your VIG goes up, you're screwed. So let's look at the SPY's advice. Don't count on that. It's not a reliable strategy due to timing challenges and rate slippage when you convert to a fixed rate. If you're gonna to bite down on the 0.99, you should be prepared to write it out. Maybe the Bank of Canada will only hike 75 basis points like they did in 2010. That would still leave you ahead at 0.99% variable, only if prime rates jumped a point or more around the mid-2023 would a 5-year rate save you more based on the interest cost alone. Now, you have to also remember it's going to cost you to rewrite the mortgage, to switch over, and to pay out your existing mortgage that you have with whoever you're with. You still have to pay out the existing mortgage that you have with your bank. Also, you have to pay a new appraisal, a new this, new document fees, new all this Mickey Mouse. So you got to do that too. So keep that in mind. So you're looking at fees of anywhere from $12,000 to $22,000, $30,000, depending on the situation you're in, right? So at this point, we can't blame the well-qualified insured borrower for wanting a piece of this rate. So basically, if you could lock in a good 5-year, that's what I would recommend. I do not give financial advice on here. So there's HSBC. How do they do it? Well, they do it very simply. What they do is, again, they have a team of just economists that work for them and kind of look at deals, how to market it, how do we get people the good. So they're looking for good clients. They're looking for top-notch, good credit scores, a good savings, a good employment history. That's what they want. And they're willing to sacrifice and lower rates to a record low that's never seen in Canada to try and get better customers. And so basically people at TD, RBC will jump ship and move over to HSBC, especially if you're 50% paid down on your home. This could be a good consolidation opportunity for the future, to consolidate and get a lower rate and lock in. But again, I don't give financial advice. I just kind of wanted to throw this out there and let me know what you guys think of this. It's kind of important because the lower the rates, the more the inflation, the bigger the bubbles, and the more problems we're going to have in affordability issues. Let me know what you guys think in the comments below. I look forward to reading your comments. 0.99%, never seen in Canada before. What do you guys think? Comment below. Thanks for watching.